So I've been investing for over 20 years now, primarily in stocks that pay dividends. I invest for dividends and cash flow. And I have a lot of subscribers here on my YouTube channel who ask questions. And one of the questions that I've received many times is, hey Ian, what are the top mistakes that you have made over the years? What are the top 5 mistakes that you have made? And so the purpose of today's video is to share literally the top mistakes that I have made in my investing career, and I am hoping that by sharing these mistakes, sharing the insights that I've learned from my mistakes, it will help everyone out there in the dividend investing community. Hey everyone, welcome back. This is Ian from ppcian.com. Today's video is another subscriber request. This is a video that is actually coming from multiple different subscribers requesting this video, so I am very excited to share some insights today. And I want to share in particular the mistakes I have made. These are the mistakes I have made over the years, and the purpose of this obviously is to share the insights that I learned, so hopefully it will help others out there. At the same time, at a meta level, the purpose of today's video as well is to show investors who may be getting started just now. They may be getting started in 2018, or maybe they just recently got started in 2016 or 17, and they're feeling like, hey Ian, you've been at this for 20 years, I feel like I'm a little bit behind. And the purpose of this actually is to provide encouragement out there, because in my early years, you'll see as I share some insights today, there is a lot that was happening. Yes, I got started in dividend investing early. It was one of the primary strategies, if not the primary strategy that I latched onto from the beginning, but I had swayed from that strategy quite a bit. There were times where I wasn't even really focused on that strategy. I'd started doing something else. I had always come back to that strategy, but I think what you'll see as we go through some of my mistakes here is, especially in the first 10 years of my investing career, there were a lot of mistakes. It was a lot of trial and error. I was just learning my way. And so if someone is thinking like, hey, it's 2018, I'm really behind, he's already been doing it for 20 years, the purpose of this really is to create some positivity and some encouragement for anyone getting started now, because yes, I've been at it a long time, but in those early years, there was certainly a lot of trial and error and learning. So let's jump right into it. I have a cool chart here today. This is my investing mistakes, and here's when I got started in the 1990s. It was in the 1990s, way back when I got started. I don't want to share all of my story today because I actually filmed a separate video. I'm going to link to it in the description below about my personal story as an investor. But needless to say, I got started in the 1990s, and I would say during my early years, I actually thrived. I did quite well in the sense that I was investing primarily for dividends. I experimented with a few different strategies. I had some mutual funds exposure, but I also had some direct stock exposure. But anyways, I kind of got started off on the right foot. I got started off reading all the right books, and certainly those helped me out quite a bit. And if you want to learn some of the books that have shaped my investing the most, especially in the early days, check out the description below. I'm going to link to my Instagram. I have some cool photos on there that actually show the books that have helped form my investment strategy. But anyways, fast forward to 1999. For whatever reason, I started trading penny stocks. I guess just as a young guy, understood the power of dividend investing, understood the power of the snowball effect, the compound interest, but you know what? It was moving a little slow. And I started thinking like, hey, if I could trade penny stocks, could I get rich overnight? Could I make several 100% gains in a matter of days when it would take years to do that with traditional dividend investing? I quickly learned from trading penny stocks that this was not a winning strategy. The fact, there were several things behind it. One, the market was illiquid, so it was really hard to get in and out of the penny stocks. Two, I didn't even know fully what I was investing in. Sure, I did my research, but you know what? On these really small penny stocks, on these really small companies, sometimes there's just not a lot of valuable research out there. Sometimes one is potentially buying into the hype, into the momentum. And so I found myself in a situation where I was waking up really early, I was in front of the computer all day, I was trying to trade these stocks, and I guess I learned the hard way through some capital loss early on that trading penny stocks wasn't for me. So that was mistake number one. Huge mistake number one. And what did I learn from that? I learned that one, I shouldn't get too greedy. I shouldn't try to make these huge gains overnight. I shouldn't buy into the hype because there's a lot of content out there, whether it be on the internet or elsewhere, that is saying, hey, Ian, you can get rich overnight. You can become an overnight millionaire. And there's all these things saying that. What I learned early on, thankfully when I wasn't trading with a lot of money, is that, you know what, all of that hype out there, there's a lot of hype, but Ian, you really shouldn't buy into that hype. You should be very cautious. You should be very pragmatic. You should do your own research. You should find your own strategy. You should stick with your strategy if you have a strategy that is working. And so that's what I learned early on. Now, one thing worth pointing out on this chart, you see this dotted line? This is basically my income level, or my level of funds available for investment. Obviously, in these early days, this was before I even had a full-time job. This is before I was a college graduate. And so certainly in the early days, my income or my capital available for investment was quite low. And then it started really going up in these years here, starting in around 2004, 2005, when I was in the workforce, I was earning a full-time income, I was getting promoted, I was rising through the ranks. And so the great thing about this, and another takeaway from this story, is if someone is young, I generally think it is a wise idea to start early, because one can get some of these trial and error out of their system in the early days. Now, I'm certainly not advocating following in my path, because I think I went through quite a bit of trial and error, and I'm hoping that the next generation of investors, dividend investors, cash flow investors that rise through the ranks, they will perhaps be even better than I was and avoid some of these challenges. But anyways, thankfully the investment capital was lower. So anyways, fast forward from 1999, 2000, 2002, there was another new craze. Well, penny stocks were never really a craze. It was more that I just kind of bought into the hype. But the next thing was fiber optics. If you've been following the technology industry for some time, you'll remember some of these fiber optics companies like JDS Uniphase, SDLI, Corning, they were just going almost straight up. It was parabolic. There was a frenzy. It was this time when everyone was in belief that fiber optics were going to change the world forever. And in a way, they did. They helped power this faster internet. I wouldn't necessarily be here on YouTube today sharing these insights and engaging with the amazing community here that we've built on YouTube without these technologies. But that being said, the valuations were just way out of whack. Way, way, way higher than they should have been. Anyways, I got into, I actually got into SDLI kind of early, and I made a lot of money actually. I made, I think, a few 100% on the stock, but then it started coming back down. I didn't sell in time. I basically, I'm certain actually that I didn't lose money, but certainly didn't make the gains, didn't book the gains. Now, what I learned from this experience, so again, first experience penny stocks was more stick to your strategy, don't buy into the hype. Second big mistake, fiber optic stocks, was be very careful about trends. Be very careful about water cooler talk. Be very careful about current hype in the media, in the press, with friends, with colleagues. Just because everyone is saying that something is the future, that doesn't necessarily mean it is. And even if it is, it doesn't necessarily mean that the stocks are trading at a reasonable valuation. From the second mistake, what I also learned is, Ian, I'm not really good at timing the market. I don't think most people are good at timing the market. If they were, there would be much more wealth out there than there is. Many of the traders would be even wealthier than they are now. And the fact of the matter is it's very difficult to time the market. Last year in 2017, I actually did time the market pretty well. I got into Bitcoin low and I sold high. I'll link to that in the description below. That's kind of an ancillary investment strategy that I carried last year. But in general, I focus on dividend stocks. And I would say what I learned back here with the fiber optics craze is, Ian, Don't try to time the market. And with Bitcoin, by the way, I wasn't trying to time the market. I was more trying to buy it and hold for the long term because I saw long-term appreciation. But the fact of the matter is it just went up overnight. It started going parabolic. And then I realized, oh, okay, I need to get out immediately. And I did, and I booked the gains because, hey, I've seen this before. Back with fiber optics, goes way up. It's probably going to come back down at some point. And maybe it'll go back up more in the future with Bitcoin, I don't know. But anyways, that's a lesson I learned here. But what I also learned is this strategy of trading, buying low, selling high, it can be stressful. This strategy is not really predictable. The strategy is very difficult to execute. And so I learned early on that really trading, yeah, it's kind of fun for a young guy to be doing some trading, but at the same time, it's not what's in my long term. It's not my long-term strategy. And so, wow, early on here, just in some of my earlier years, thankfully with less capital, I learned about being wary of hype, and I learned about being wary of buying low, selling high, and getting into crazy markets. Next, let's fast forward to big mistake number 3. So we're coming out here to about, at this point, like we're looking 2005, 2006. If you all remember back to that time, it was the subprime mortgage era. This was the era that there were lenders out there. They were extending loans, home loans, to people who maybe shouldn't have qualified for as much money as was being lent out. And the terms of some of these loans were kind of weird. It was wacky. Basically, the whole thing collapsed and there was the big government bailout. Well, anyways, during that time, and again, keep in mind, I've always kind of as a baseline had my mind as an income investor, as a cash flow investor. And as time went on, I started realizing, especially after penny stocks and fiber optics, Ian, you probably ought to stick to your cash flow strategy. It's probably the right strategy for you. But anyways, okay, here comes a stock during the subprime crisis that's yielding, I think it was yielding like 15%. There's this company, Nova Star Financial. It was a mortgage REIT. Subsequently, I read online that they have gone bankrupt or filed for bankruptcy. And so, anyways, during those years, I was investing in this company, and I was attracted to it because I saw a 15% yield. Why would I buy a company that's yielding 2, 3, 4% when I can get 15%? I want that higher yield. That's what I was thinking. Well, anyways, what this is called is it's called a yield trap. The reason the yield was so high is this company was not practicing at the time sustainable practices, and it was not, in the industry in general, was not practicing sustainable practices. And eventually the whole industry crumbled, dividends got cut, companies went out of business, consolidation happened. Thankfully, with Nova Star, I actually did not lose. I got in, I got out, I realized my mistake quick enough to get out of it without losing my capital. But this was a mistake in the sense that I could have lost a lot of money, and it was an interesting mistake. I'm glad to have it on here because it was how I learned during my career to avoid a yield trap. I don't want to buy into companies where the yields are really high and they're not sustainable, they're not supported, they shouldn't be that high, or they are that high because the stock's down and it has no hope of recovering because the business faces fundamental challenges. And so from this point on, I always invested in fundamentally sound companies that have had a huge track record of paying dividends, oftentimes increasing dividends, and they have a sustainable payout ratio and a huge propensity to be able to do so in the future. So I learned a lot from that experience in avoiding yield traps. And these are kind of the mistakes I would say that a younger investor makes. It's typically the mistakes, the genesis of all 3 of the mistakes discussed so far are out of a desire for quick money. When someone is a younger investor, especially younger like in their age like I was, this allure of making a lot of money, making quick money, making it fast, it is out there. And I think it's part of our culture, part of our society, part of the media. And so I tried to make the quick money on penny stocks. I tried to make the quick money on fiber optics. And then with Nova Star, maybe 15% a year is not quick money, but it's a lot quicker than 3% a year. And so I was chasing the quick money. I was still doing it just in different ways. Thankfully, again, capital being invested all these years wasn't huge because it was before the days where I was really starting to earn more income. Anyways, let's fast forward here. Huge mistake number 4. And I don't know if this is I mean, in the scheme of things, there are investors out there on YouTube who live extremely frugal lifestyles. I am not one of them. I am challenging myself to be more frugal, but I tend to believe that balance is good. I like to buy stuff. I like to have nice stuff. At the same time, I want to have the balance, and I want the investment portfolio, and I want to get financially free at a young age. Anyways, I got ahead of my skis. In circa 2007, I bought a BMW M3. And this was an expensive car. It was a car that was way over my means. It was the income that I was earning at the time certainly did not justify purchasing that kind of car. I think it's another kind of young guy mistake. I've seen a lot of other bloggers talk about this online and on YouTube, and I think young guy early on in their career want to have the cool car, want to have something to show for all of those hard hours of work that have gone into earning a paycheck. Anyways, I bought the car. I at the time actually took out a loan to purchase this car. So not only did I spend more money than I should have, above my means, but I actually took on debt to be able to buy this car. And so if there are any younger people out there watching this video, I think this is a fundamental mistake I have seen repeated in so many different avenues online. And the cars are cool, but they're... In retrospect, was it worth it? I had a lot of fun with this car, and I had it for a long time. But the upkeep of the car, the servicing, the maintenance, just the worry every time I went out and, oh, there's a little scratch on it, and I was so worried about that. All of that, is it worth it? Or is it worth focusing on money, focusing on making money, making a dividend portfolio, being frugal, spending time with people, building relationships, having fun experiences? So there's certainly pros and cons, and I don't want to discount the value of a fancy car because I love cars. And in my future, when I am financially free and my income level keeps going up, my investment level keeps going up, I have aspirations to be involved with cars. I really enjoy cars. But anyways, at this point in my life, it was a mistake. This was big mistake number 4. And the reason this was a mistake is I basically wiped out any chance I had at that time of getting money to work for me in the stock market. Instead of putting my hard-earned money in the stock market and dividend stocks, now I was just focused on paying off this car. And so it's a huge distraction. It was a huge mind share, and it took a lot of just time and energy to maintain this car. But also, imagine if I just put the money in the market. Imagine if that money had grown. Imagine if I had stocks that were paying dividends, that were increasing the dividends. I knew all about this. Like I said, even since the early days, I was very fond of the dividend strategy, and I was doing it at some capacity throughout all of this, but this was a huge expense that basically took away from my future self for some short-term enjoyment as my present self. But in retrospect, was it even that enjoyable to have the car at all? I don't know. There's times I actually miss that car, but that being said, I classify this as in general as a mistake, because I could have bought, for example, a car that's very nice, a luxury car, but just I didn't have to go for the BMW M3 convertible, which is just so expensive, so outrageously expensive. I could have had a very nice car for half or less than half of the price, and that probably still would have been, according to most experts out there, a financial mistake, but it certainly would have given me the enjoyment of having that flashy car at a young age while still having capital. Thankfully, I got lucky. If you've been following my journey here on YouTube, on my blog, you may know that I do a little bit of angel investing as well. And there's 2 ways I've done angel investing over the years. I've done it by working at tech companies and getting equity in the companies that I've worked at. And I've done it just in more recent years just by being an angel investor, not working at companies, but being an advisor to companies or having connections in the industry and having opportunities to invest. This is a very small portion of my portfolio. It is 10% or less. That's what and cryptocurrency, Bitcoin, that falls in there too, although my Bitcoin holdings in crypto are mostly gone at this point because I've sold them. But anyways, I had a lucky event around this time where one of the companies that I'd worked at got acquired. And so thankfully that freed up some cash from that quote-unquote angel investment, which I got through the employee opportunity from the employee stock options to buy stock. And that helped me basically pay off that car. But the fact of the matter is I could have used that money for a lot more good. I could have used that money to greatly further my dividend portfolio way back in 2007, which could have done a lot of compounding over the years. Anyway, so that's big mistake number 4. This is more, so the first 3 big mistakes were about kind of quick money, making quick money. This is more of a budgeting mistake. This is a budgeting mistake that oftentimes younger men face because they want that flashy car. And so that was where I really started learning about mistakes that can be made through budgeting and why I need to be tighter on my budget, although I'll tell you I'm still not there. That's one area where I can continue to improve by far. I think on the portfolio side, on the stock selection side, the fundamental analysis side, the discipline side, I've got that. The budgeting side, I still have a lot to learn. So let's fast forward now to 2008. 2008 is, I would say, around the time where I really get it. I have learned from these mistakes, the 4 big mistakes that I've made so far. It wasn't my last mistake. I still made another mistake here in 2014 through 16, but I really get it. I'm all in on this dividend growth strategy, income strategy. It's been there all these years, but I'd always gotten distracted. There's always been something. I got distracted by the penny stocks, the fiber optics, the subprime mortgage. Well, technically that was dividend, but it was a yield trap. I got distracted by the BMW. Now I'm really all in this thing. I am in it. I get it. And so the reason I include this actually is this is 2008. So for those of you that are thinking, Ian, you've been at this 20 years. How can I ever get started? I'm just getting started now. And I'm older than you were when you got started. I want to show this because these years, one, I wasn't investing huge amounts of capital because my earning potential, my capital for investing wasn't as high as it would be in later years. But 2, I had some mistakes over those years. So yeah, I had a dividend portfolio that was growing and doing okay, but I was still figuring things out. Here's where I really got it. So this is the point of this, to show this, is now it's been 10 years of real focus, real focus, and doubling down on the strategy that I've come to love, which is dividend growth investing, investing in world-class blue chip companies for their dividends, and I now own 36 of them. Anyways, income kept going up, opportunity to invest more money kept going up, and so I just started really plowing in, and I guess I got lucky in the sense that I really got it right at the peak of the subprime stuff, and before, right around here is when the market started tanking. And so I really got it. I was all in, but I was also all in at a time when stocks were dropping. And so I was buying. I was buying better and better values. I was buying at the bottom of the market. And so I would say that was favorable for me. And so then, and it surely allowed me to accumulate a portfolio at what I would call value bargain basement prices. But I always buy. I'm always buying. I'm always in the market. If you've been on my YouTube channel for a while, you know that. So from here, it's pretty much been smooth sailing. And as the money's gone up, I've just really focused on getting the capital to work for me. Now, that being said, a seasoned investor who's been through all of this, it is still possible to make mistakes. So what is big mistake number 5? Big mistake number 5 is when I purchased BHP Billiton in 2014. I ended up selling it in 2016. And this was a stock that was really popular on all of the blogs. All of the dividend community blogs out there were buying BHP Billiton. And I guess I was attracted to it because I didn't really have exposure in my dividend portfolio to base materials. And so I was thinking, hey, I ought to buy some BHP Billiton. And so I started buying in. And it is no one's fault but myself. I did all the fundamental analysis. It seemed to check up more or less. But anyways, I bought in. I lost upwards of 33%. I got out. This is just one of 36 stocks, or 30 plus stocks. It's not been 36 all these years, but right now I have 36. But you know, during this time I had a portfolio of upwards of 30 stocks, and it's just one. And so the lesson here is, one, don't follow what others say. Come up with one's own investment ideas, do one's own fundamental research, do what feels right in your gut, and stick to your own strategy. This is one of the reasons, quite frankly, that I like to avoid sharing all of my stock holdings in one central place online. I know a lot of dividend bloggers do that. I have other reasons too, but that is one of the reasons. I think it is too easy for someone to see what another person is doing and then take the shortcuts. Potentially, it's tempting, it's human nature, it can lead to mistakes like this. And so, that being said, I blame no one but myself for this mistake. And quite frankly, big mistake number 5 wasn't as big, because this is going to happen. When one is a dividend growth investor and owns a portfolio of over 30 stocks, there's always going to be one or two where it is a mistake. This is one of the reasons I like to diversify. This is one of the reasons I like to have a portfolio over 30 stocks, because it is impossible to perfectly analyze every stock, to have a 100% success ratio. It's just not going to happen, and so the diversification really helps out. But the lessons I learned here were basically, be very careful about following others. In fact, when I buy a stock, I prefer that it's one that I came up with without even looking at anything out there on the internet, any of the blogs. And then if I see, oh, other people have it, good. But if it's something that was generated from a YouTube channel or a blog, and that's the first time I had heard about it, that's the first time I had seriously considered it, I don't really like that. That spooks me a little bit. It kind of, it concerns me about the future of that investment. And so that was big lesson number 5, or big mistake number 5. And I'm sure I'll have other mistakes in the future. It's impossible to be an investor without making a mistake. But thankfully, I had a concentration of mistakes in the earlier years that really, I would say, set myself up for success. And so before I close today, the high-level takeaways are, 1, I hope you enjoyed this video, and I hope you enjoyed hearing about some of my mistakes. Hopefully they are helpful out there for others. I think, 2, in my opinion, it is never too late to get started with investing. Certainly getting started in 2018 is different than getting started when I did that, and I have a video on that. I'll link to that below. And so certainly if I were starting out fresh right now, I would proceed with caution, because the market has gone up quite a bit. And so I have videos about that here on my YouTube channel. But that being said, I don't think it's too late, because yeah, I've had 20 years experience, but it's the last 10 where I've actually had income, job income, to be able to invest. And it's the last 10 where I really started to get it. I got it. And I was beyond and past those particular mistakes in the early years. And so I think the other thing is, if one is an investor and makes a mistake, it's not the end of the world. It's not a reason to get discouraged or to go on the sidelines or to forget about investing. This is a process. This is an evolution, and all of us make mistakes. That's how we all learn in life. And you know, this could be a completely different topic other than investing. It could be something different, and I've probably made as many mistakes in other areas, you know, job or whatnot. There's all kinds of mistakes that are made, but this is how, as humans, we all learn. So thank you whoever asked that question, or to the many people who asked that question. That was a good one. I enjoyed that one. Before I leave today, just a friendly disclaimer. This is not investment advice. I am not a licensed investment advisor. Today's video is just for fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. And in terms of full disclosure, I do not own any of the stocks listed on here anymore. But as we discussed earlier today, I do own some Bitcoin and other cryptocurrencies in my portfolio still. So I do have some of those, and that's something we discussed today. Thank you so much for watching. I will see you in the next dividend investing video.